the founder originated from Norfolk as well, and we just finished up with our accelerator and doing real well. So we're actively looking for startups wherever we go, and we love running for stuff that works. So what I'm going to talk about today is I'm going to talk about what we see, how we see startups changing. I'll talk about how VC is changing, venture capital is changing, and then I'll kind of try to tie that together and talk to you, give you guys tactical tips on how to take advantage of that, regardless of whether you're a founder, an employee, an investor, or anything else. Let's keep it as interactive as you want. So if you have any questions, just holler out. We'll do a Q&A thing at the end as well. These slides are all online as well. So don't worry if I go too fast or anything like that. They're all online. I just tweeted out the link, and you can download them from SlideShare. So just to start, let's just start with a cliche. The fact of the matter is that early stage startups have changed already. They look very different than they did 2 years ago. They look very different than they did 5 years ago, maybe even 10 years ago. So a couple of those underlying trends. The first thing is that startup costs are lower than ever. And I think most of you will not disagree with me on that. I mean, the fact is you guys are able to do a lot of this stuff here, come up with an idea on a Friday, and potentially have a paying customer by Monday. That was simply not possible 15 years ago. Right? To give you some sense of this, right? Like when I started my first business about 15 years ago, in order to just get started, you had to buy a physical server, find a data center somewhere, and plug an Ethernet cord into the back of it. I'm just curious, actually, how many of you have ever held an Ethernet cord? That's actually surprisingly more than I thought. Never mind. Okay, so I thought there was going to be like one hand, and it was going to it's going to be my hand, but anyway. So the thing is, so here's the thing, right? The fact of the matter is that 15 years ago, you needed, figuratively $5 million to get started. In 2002, roughly, Red Hat, and open source Linux kind of take off. I would argue that the costs dropped to about $500K at that point to start a business. Around 2007-ish is when the cloud really took off, and I would argue at that point, the startup costs went down to about $50,000 to start. And today, because of the technology available to you, via your laptops and accessible languages like Ruby on Rails, and even if you're doing hardware like devices like MakerBot, the point is that it's really accessible. And if you're a founder, that means that you almost have no excuse to not have a prototype before you even raise money. And as an investor, what that means is that you're kind of crazy if you invest in just ideas. And I'll talk more about that in a few minutes. Now, one other thing I want to mention here, though, is as the costs come down, the dirty secret of this is that once you hit product market fit, the costs go up. Everybody understand that? So it's cheaper than ever to start, but it's almost always the case that it's more expensive to scale now, and that's because your customer acquisition channels are getting saturated. The next big trend that's kind of changing startups is as the web gets bigger, the world gets smaller. And what that means is that traditionally you would never find, this is going to sound awkward, you would never find a Silicon Valley investor anywhere off of a major international airline hub. Right? So in other words, most VCs would only ever hang out in their hometown or like New York City or London or whatever else, and that's because all the deal flow was there, all the companies were there. But the world's getting smaller. Things like AngelList allow me to see more of you remotely, and it allows you to see more startups remotely. It just basically makes the world a lot more transparent. The thing I like to say with this is that capitalism and the internet are very, very efficient at transmitting ideas and sharing ideas, right? But the double-edged sword there is that good ideas can propagate very quickly, and bad ideas can propagate very quickly. So what we have to be careful about is figuring out how to differentiate the two, and we'll try to talk about that. The third underlying change is that tech differentiation no longer matters, especially when it comes to web startups. In this day and age, traction is the new intellectual property, and traction, in many ways, is the only thing that's defensible. Right? And to make that point, I would just point out, look at things like Facebook. And I know that sounds awkward, but look at Facebook. You have 1 billion monthly active users. So if you're a founder and you want to create another social network, you better have a really good way to get 1 billion active users. Otherwise, it's a fool's errand, right? So the point is, though, is that it's no longer good enough to think that you have better tech or anything else. And remember, I'm saying this as a general thing. Like, certainly if you're doing deep hardware or if you're doing anything that's like, you know, especially like university research, sometimes those things are patentable, but it's almost always the case that it doesn't really matter. The next thing is, believe it or not, capital is increasingly commoditized. And I know that might sound kind of awkward and maybe even unbelievable, but the fact of the matter is that 15 years ago, if you think it's hard to raise money now, just consider the fact that as recently as like 2 or 3 years ago, events like this didn't happen, right? There was no angel list. Nobody was investing in these asset classes. You arguably have it way easier than I did 10 or 15 years ago. You have it way easier than anybody that was raising, you know, even 2 years ago. I believe that this decade will be remembered as the rise of the angels. If you agree that costs are coming down, you don't actually need to be an investor. You don't need to have the ability to write $100,000 checks anymore. You can write $10,000 checks. In fact, at 500 startups, our median initial check is $50,000. Everybody heard that, right? It's just $50,000. We behave as angels in the first round, but we behave as VCs in the later stage. So we can go heavy into you if you need it. But the reason we're able to move so quickly is because in the grand scheme of things, for a VC, $50,000 isn't a whole lot. And it can be incredibly meaningful to you guys because you may only need to raise $100,000 to start. You know, I was actually talking to, I don't know how many of you attended Mike's talk from Carlots earlier. What I thought was really interesting, I wish he had said it during the talk. I think he just forgot, but like what I found really interesting about what he said was, he said that he raised $525,000 to start Carlots. And I asked him if he would do anything differently if he were to do that again today, and he said he would have raised less. That's pretty surprising. Most people surprisingly think they need lots of money to start. You really don't. So capital is becoming more commoditized. It's easier for you to find. And believe it or not, money is now following founders. Okay, so for the early stage, it is the case that VC is following the founders. We have to go to where the founders are now. Now, it's a little bit different at the later stage, right? Like at the later stage, if you're going to go raise 5, 10, or 50 million bucks, unfortunately, like the guys that run those firms, unfortunately, it's almost always guys. There should be more women in venture capital, but unfortunately, those guys are like living it up in these big cities or whatever, and you'll probably have to like schlep up there. But for the most part, if you're raising less than 500K, you can do it remotely, and we're coming after you. And even if we're not physically here, we're looking at it on AngelList. And just to make this point, if you look at AngelList, and this is like public data, you can just go follow it yourself. Wait, first of all, I assume everybody's familiar with AngelList? Okay, if not, just Google AngelList. You should get on it, and we'll talk about that as well in a little bit. But just to make a point here, AngelList is a platform for founders and investors to meet, right? And so they do thousands of introductions between these people from all over the world, and they've been doing it for 3 years. The more interesting part is that about 12 weeks ago, they announced an Invest Online feature. So now, if I want to do it, I can just click, do the deal, and wire you the money all through the platform. And I think on their blog, they actually showed that the first week, they did something like $1 million in transactions between founders and investors, right? And now, if you look at the ticker, they actually have a ticker on their website. They do something like 20 million bucks, it seems like, a month. And for full disclosure, we are investors in AngelList. I just got to be careful. I can't disclose everything. But look at their website. If I gave away too many numbers, it was on the website. But because of this, not only do I think this decade will be remembered as the rise of the angels, it'll be remembered as the rise of the entrepreneurs. Businesses of tomorrow will look very different than businesses of yesterday, right? And this is actually, just as an aside, I'm going to rant for a minute. The problem with most of the politicians today is, one of the problems, is that their thoughts around economic development are built around the idea that you guys will be able, for example with Norfolk, that you'll be able to attract another General Dynamics here, or you'll get another Lockheed or another Boeing, that you'll get another 5,000 employee company to get here. But not only do those firms not exist, there's a finite number of these big firms, but getting like a headquarters or something to migrate is incredibly hard. On the extremes, if you look at startups today, look at the economies of scale. So if you look at Instagram, and look, we could argue whether or not that's a good business or not, but if you look at Instagram, $1 billion valuation when they sold. Does anybody know how many employees it was? I got a 2, I got a 13, what was it? I believe it was 13. And you want to know what was especially, so if that doesn't scare you, right? What should scare you is actually that the founder he was accidentally here. He was actually a Brazilian that came to this country on a STEM visa. And if we had kicked him out, that would have been a Brazilian company and $1 billion would have left the US and gone down there, because the reality is you can operate a business from anywhere now. Anyway, we'll leave the politics aside, but money is following you. Perhaps one of the biggest trends, the biggest changes in venture capital now and in early stage startups is that signals are everywhere. And what I actually mean by that is that transparency is everywhere. So just give me one more actually. So transparency is everywhere. And what that means, so in order to explain what that means, let me actually give you an example from the public markets. Right? So the public markets, let's just call that Wall Street, let's call that anything where you're trading commodities, stocks, anything, right? Has anybody seen these pictures before? If you follow the financial markets, you might have seen these pictures about a year ago. It was a huge story. I guess I'm like the only finance nerd, but those are pictures of Walmart parking lots. And what that was is UBS. Everybody know UBS, big global bank? They disclosed those pictures as part of this investigation that they were under because they were really, really scary good at predicting whether your quarterly earnings reports for public market companies were going to be higher, lower, or average. Now, you can read that if you want, but what that means is what they were doing was not only did they have smart analysts, smart MBAs, smart everything else, they were actually paying a satellite operator to take pictures of every Walmart parking lot every hour of every day and counting the number of vehicles that park there. Do you understand how important that is? Like how big that is? That's like incredible. And everybody's doing it, but nobody talks about it. They only started talking about it 2 weeks ago, or 2 years ago. So I'd be really surprised if anybody recognizes this, but that field on the left probably impacts your life on a daily basis than you realize. Does anybody recognize that field on the left? No, okay. That's okay, like not very many people know about this, and I actually had to if you look at how nasty that picture is on the right, it's very rare to find that picture, and that's a Polaroid that I had to buy off of somebody and scan in. That's the Cushing oil field in Oklahoma. If you watch the nightly news, they'll say something like the price of oil was this, right? They'll say the cost of a barrel of oil is this. You guys know what I'm talking about? When they say that oil is kept in Cushing. When you buy a commodity, an oil trade, you trade the oil shares on Wall Street, you're actually trading oil that physically sits in that field, okay? So it impacts your life, right? Because the cost of oil determines everything from food to everything else. You guys know this, right? This is normal? This is regular? Okay. That picture on the right is a close-up of the roof of those tanks. And if you look, so I'm legit now. I have a laser pointer that somebody gave me. Oh, we're going back, actually. Just go back to those pictures. Sorry, the tanks. Yeah, this one here. So this right here is a picture of the roof of those tanks, but now the tanks have covers on them. And the reason is that when you build an oil tank, the roof has to float. Otherwise, you're supporting a lot of load, right? So what this company Genscape was doing What this company Genscape was doing was flying a helicopter over the tanks twice a week to just figure out where the roof was. Not rocket science, guys. Because here's the thing. So Economics 101, Ian's going to love this, wherever you are, Ian. So the thing is like supply and demand. If I know that oil is getting pumped out of the tanks and going to the market, what happens to the price of oil on the market? No, it goes down. Oil's supply is increasing to the market. It's getting shipped into the market, so price is going down. If the roof starts rising, they're storing oil, they're pulling it off the market. Price goes up. And if you have even a half-hour head start on knowing which way that roof is going, you can start to do very interesting arbitrage things where if you have that knowledge, you can start buying or selling. You can go long or short before the market will. And that's the thing, right? Like data is just being used everywhere. So this company, by the way, and this is all legal. Everything I'm telling you is all legal. It's been happening for at least the last 20, 25 years. It's been happening for a long time. This company, Genscape, if you go to their website, and this is like, just go there now if you want. If you go to their website, not only will they sell you feeds of what their helicopter sees, they've got infrared sensors that are pointed at these tanks so that if you believe infrared readings, you can buy that. If you prefer to trade in electricity, they've got electromagnetic sensors sitting around high voltage transfer lines, and they can tell you how much voltage is going in which direction. Anything you want is quantified, and you can buy it, and you can use that to then arbitrage the public markets. And as an aside, by the way, let me just point out that, and this is important for where we're headed with all this, right, that where I'll get to. In 1950, the average public market stock was held for 6 years, right? So in 1950, when you went on, there was no E-Trade back then, but you would go and you would say, I want to buy 1 share of IBM or whatever, or Ford Motor Company. The average investor would hold it for 6 years. By 2000, the average time that same share was held was 6 months. So public market stock volume trading is doubling almost every 4 to 5 years. Today, because of high frequency trading, most shares are actually held on the order of milliseconds. And I know you may not think this actually affects you, but I guarantee you it does, and it will, and I'm going to show you how it does. But this is really important because the fact is that today, on the public markets, nearly 75% or more of the daily volume trading is electronic, and it's almost always automated, right? Machines are pricing the public markets, not you or me, and that's something that we're going to get to that's going to affect you guys as well. Wall Street's not alone. So if you've ever gotten a car loan, a home insurance policy, financing for in vitro fertilization, right? Data is being increasingly used against you, and this is real. This is real. You can just go do your homework, you'll find it. In fact, actually, one of the biggest sort of scandals recently was I think about a month ago in this industry. So every Thursday morning at 10:30 in the morning, I'm probably a little off on some of the details here, but every Thursday morning at around 10:30 in the morning Eastern time, the United States government issues a report about the natural gas reserves that we own, right? Somebody started trading on the electronic markets 400 milliseconds before everybody else, 400 milliseconds before that report leaked. And now there's this big investigation about figuring out, did the report leak? Or was there, and somebody was trading on illegal information? Or was it actually just a speculator that was trying to move the markets, right? There's just very sophisticated stuff happening right under your nose. Now the thing is, we can do it too on the private markets. And the biggest platform for that, I would say, first big platform that allowed us to do that was AngelList. Thousands of startups, thousands of investors, all their data is public. I can see who's following who's getting introductions to who, right? And this is real. You can go on there. You can see all that right now. You guys have probably all been using some combination of these services already. The point is, there's so much data about your behavior online now. And we can take that data. And the bad news is for you is that we're doing it. So it takes away so much of the drama when I can't control it. So the thing is, if you just look at Google Ventures and Correlation Ventures up here, just those two, those are new firms, less than 3 years old, that manage a combined asset number of about $500 million, trading on data in the private markets. Right? You got 500 there, you got general cap, and this is just the tip of the iceberg. Right? Data, you must understand that data is going to be used increasingly against you as founders, but I hope that as we talk through this, I'm going to give you the tools to kind of use that to your advantage as well. So we talked about startups so far. Before I jump into the venture capital side of it, any questions? Concerns? My goal here is, by the way, to either intrigue you or scare the shit out of you. If I walk out of here and you're not polarized, then I did it all wrong. No questions. Okay. All right. So venture capital, right? So this is one of my favorite quotes. It was said by the founder of AngelList, I believe before he founded AngelList. He said this in passing, and he basically said, venture capital is open to attack by disruptive new tech and business models. In other words, what he's saying is venture capital should be run like a startup. And that's a really interesting thing, because the thing is, so early stage has already changed. Early stage venture capital has already changed. Here's the dirty secret. The dirty secret is this industry, the industry that I'm in, is not very sophisticated at all. It's not sophisticated at all, right? If you think about it, how many times have you talked to an investor and they say the words, I think or I feel? A lot, right? They'll say, I think you're onto something. I feel like this isn't a big market. It's all this fuzzy stuff, right? But what the funny part is that we manage billions of dollars, but we are the only asset class, arguably the last part of private equity, that is still allowed to say stuff like that. Because when you call your bank, if I called Navy Federal and I said, hey, how much is in my checking account? And the person on the other line goes, well, yesterday, I think it was like this. You would throw a shit fit, wouldn't you? But somehow that's okay in venture capital. In venture capital, it's okay for me to be like, yeah, I think that guy's going to win. I'm going to give him a bunch of money. And then if he succeeds, I'm going to be like, yeah, I can predict the future. And if he fails, I'll be like, that fucker lied to me. I don't know, he totally lied. I mean, he's an idiot. We're going to sue him. It's cool. Give me some more money, right? Here's the thing, right? In all seriousness, the problem is that in this industry, we think that we're very good at predicting things. But if we look at human behavior all throughout history in anything, whether it's poker, gambling, right, anything, we are overconfident when it comes to prediction. And what we need to do as an industry is recognize that we're not good at it. The only thing that venture capitalists have been good at as an industry is losing money. Right? But you guys look at the industry and say, these guys predict the markets, they predict the future. We don't do shit. Right? All we do, the default state of your startup is failure. The only people that can get it out of that default state is you. And the only thing that we do is accelerate the outcome. That's it. And any VC that tells you otherwise is lying to your face, and you should just call that out. So one of the big changes, by the way, if you think I'm wrong, just say it. Feel free to heckle. You're not going to hurt my feelings. So the thing is, one of the big changes in venture capital is there's an unbundling of advice, control, and money. What this means is that I used to give you a check, right? I used to give you a check, and then you would be beholden to me. You must get advice from me. I control you. Everything. I am your new master, right? But that's not the case anymore. If you don't believe me, how many investors do you know now that actually have mentor networks? Mentor networks, right? That's the advice part. The control part, well, traditionally we would take board seats, but why take a board seat? If I know that you're probably going to want to raise more money in the future, do I really need to waste your time sitting around a boardroom table, once a month and shooting the shit? I'd just rather be there and just, if you're like, hey, yeah, we raised $500,000 last year. Thanks for helping us out. Here's all the numbers. We're going to want to raise $5 million more. I probably have a little bit of implicit control around you, right? The point is, though, is that advice, control, and money are separate now. And I think most VCs haven't caught on to that. The other thing is, the next thing is, it used to be about capital, deal flow, and judgment. So venture capital was a small industry, well, sorry, it was a big industry by dollars, small industry by number of players, right? So, and traditionally they were in Silicon Valley, or they'd be in New York, or whatever. And the thing is, though, is that like, what they would say is, well, if we have all the money, the capital, then all the deal flow will come through us, and then we can just use our judgment, right? I mean, does that make sense? Does that seem reasonable? But here's the thing. That is a lie. You need those things to get off the ground, but not to run venture capital. Venture capital has always been about access to the deal. And let me use an analogy. Let me use a sports analogy about this. So if you look at like a football team or baseball team, right? What I'm really suggesting here is that the scouts at those teams have far greater influence on the outcome of the team than the budgets. So, or than the front office or anything like that. And what I mean by that is, if you have the front office making all the decisions, right, and you say, okay, well, we're the Orioles or whatever, and you can use that brand to somehow bring a player down from $12 million to to $8 million, that's a win, maybe. But actually, if you have a really good scouting organization, maybe you could actually find a better player or a developmental player that you think can get there and only pay him or her $400,000. So the biggest wins in terms of multiples are in the scouting. In other words, in our industry, if we bring it back to this, if I get in first at 50K, like if I admit that I don't know which one of you will be the next Mark Zuckerberg or the next Victoria Ransom or anything, if I admit that up front, but then change my behavior to just index the best of you with $50,000 initial bets, I now have access to your future deals. When one of you takes off and becomes a billion-dollar company, I was pretty early. And now it doesn't matter. Like, you guys don't care whether I manage $1 billion or $100 million. You never cared. You just want the capital and you want to build your business. Most venture capitalists don't understand that it's about access. That's the reason why I think, are there any other VCs here? Nobody wants to admit it, maybe. I think it's safe to say that I'm probably the only VC in the room right now. And that goes to show you that not very many VCs realize that if they don't get in here, if they don't find you in the early days, then they're fucked. Because the paradox of investing is that I want to invest in the smartest of you, but the smartest of you and the most successful of you. But the paradox is that you people, by definition, don't need me. Does that make sense? That's the thing that people don't understand, is that they think that like that the smartest people in this room will come running. And this is the funny thing about crowdfunding, by the way, if you guys are familiar with that new legislation that's coming out. And I think this is sort of such a elegant marketing campaign. Whoever decided to call it the Jobs Act is a genius. Like, give that person a pay raise, right? Because like, it's amazing. The thing is, crowdfunding was sold to all of you as, hey, Joe the plumber can now invest in the next Mark Zuckerberg. True or false? Is that kind of how you understand it? That almost anybody can fund a company? Well, if we agree that most startups fail, right, and that most of the returns come from the top, 5% of the companies anyway, is it the case, would Mark Zuckerberg theoretically ever go to Joe the plumber? No way. No way. The thing about crowdfunding is that crowdfunding will be great for you guys to fill your round, not to start it. So when you want to go raise a $250,000 or $1 million, crowdfunding is not going to help you start that round. You're still going to have to use traditional methods to get the first 100K or the first 200K in, but then crowdfunding can just fill in and follow fast. And that's the thing you guys need to understand, is that like don't believe this idea that Joe the plumber is going to recognize your brilliance. By the way, let me give you also a piece of advice. Never be somebody's first investment. Like, if you remember nothing else as new entrepreneurs here, never be somebody's first investment. Do you know why? Like, just imagine, like, let's say I've never invested in a startup before, but somehow, like, I love what you do, or you're like my friend's kid, and man, I just here's 10,000 bucks. Well, like, I don't know anything about you. Now I'm gonna hassle the shit out of you every day, like, hey, what's going on? Like, I'm gonna bother you, and I'm never gonna let you build a business. I'm gonna ask you questions that aren't relevant. I was actually in DC last night, or 2 nights ago, and actually, if anybody's watching this, it was not 2 nights ago. It was some period, at some point in the past. So I'm not gonna like give this away. But the point is, I was with a bunch of angel investors, and I was listening in on their demo day. They were looking at a bunch of deals, and so like I was just sitting on the back end, like in the back of the room. I just wanted to see what it was about, and so the poor guy that was pitching, I thought he had a great business, but anyway, so he pitches. And they start asking him questions, and I let it go on for about 5 minutes. I let it go on for about 10 minutes, and then finally I got up, and I just like blurted out. I'm like, you people are asking all the wrong fucking questions. You shouldn't be investors, and you're a good founder. Like, we should go talk later, but you should not take money from anybody in this group. It's just the questions. Like, this was a consumer app, and the market size was big. Like, but these people were asking questions about market size. I was like, look. Like, half the population of the planet is probably in the market size, but like, what are we doing here? Anyway, so I'll stop. I get on these like rants every once in a while. So it's about access. I think the third thing in venture capital is we're changing into a checklist-based format, believe it or not. And I would argue, so this is a checklist we use at 500 Startups, but I would argue that most VCs, even though they don't articulate it, this is what they're looking for. You should have a prototype. You probably should have a few people using it every day. You probably should have one customer. I think that founders would be so much better, regardless of let's say you never want to take venture capital money, I still think you would be better off if you learned to think like investors. And here's all you need to know. Here's all you need to know. When you think about a business, there's 3 main areas you should think about. It's product risk, market risk, and distribution risk. That's it. You can push spreadsheets, you can get an MBA, you can do all that stuff. None of that shit matters. Those 3 things. Product risk, can you build it or figure it out? Market risk, are there 0 customers in that market? Are there 10,000 or 10 million? Right? And then distribution risk, are you selling through a gatekeeper? Or are you able to kind of go underneath? So let me give you an example. That's actually, and I'm going to talk about this more, but distribution, I would argue, is what you need to think about mostly. So the thing is, so I'll give you an example. So like when I see music startups, right? I bet you there's probably like 5 music startups in this room. So here's the problem. The music industry is pretty much a monopoly. Like if you're not like Def Jam or any of the big guys, you're nobody, right? So great product. There's a huge market. Almost everybody loves music, right? But distribution, like if you're not one of those top 10 guys that control the markets, you'll never break in. We can argue it all day, but that's what I would tell you. Now, like if we look at Apple, I think if we look at Apple, Apple did something really profound. Apple created a device that arguably, so if you think about like your corporate jobs, right? If some of you might have corporate jobs. 5 years ago, it was all BlackBerries in your jobs, right? It was like if they gave you a phone or if you used a work phone, it was a BlackBerry. Is that right, mostly? But today, there's iPhones in there, right? Now, if you remember, most people didn't think about this, but if you think about it, Apple, like selling to the enterprise is way more lucrative than selling to individuals like you and me, right? But what was Apple going to do? Go to the CIO of these companies and say, you know that thing that you spent like hundreds of millions of dollars on called BlackBerry? Yeah, you should just throw that out because we got a better product. That sale would not go well. But what Apple really did, whether they know it or not, I'm sure they knew it, but I think it's like they figured out the consumerization of enterprise. They built a product, sold it to us in our personal lives, and all of a sudden, here we are, most of us as a population, looking at our work phone that we have, a BlackBerry, and then the iPhone that we bought this weekend, and we're like, dude, I just want to take the iPhone to work. And all of a sudden, people just started connecting their iPhones directly into the Exchange servers, directly into the mail servers, without the CIO's permission. So the point is, though, just think about those three things, and you'll be fine. And again, by the way, that list, you can download the slides and take a look at it. We publish that list everywhere. So we talked a little bit about VC. We talked a little bit about startups. Now let's talk about what that means for fundraising. And by the way, I should say a lot of what I'm saying is for the early stage. This is if you're raising 2 million or less. You know, so if you're raising like 10 million or more, that's like all bets are off. That's a whole different industry. So now everything's kind of moving to standard terms. It's usually convertible debt. It's usually vanilla. It's really simple. It probably shouldn't cost you more than $2,500 to get all the legal stuff done, right? So, and this is not to say that valuations are all the same. It's just that the material terms are all the same, and we can just change the numbers on it, right? If you remember nothing else about this point, just remember that legal and finance are the only things you should not innovate in. Everything else, all bets are off. Does that make sense? By the way, is this good? Is this boring? You can heckle me out. It's fine. All right, so the next thing that's changing, no fixed amounts. 5 years ago, you would stand up on a table, kick the stapler across the room, and you'd say, I'm going to raise $500,000, and I'm going to go find a lead, and then like you would probably not raise that money anyway, right? Because like it's hard to find a lead. The point is today, because it's convertible notes. It's just rolling. If I like what you're doing, fuck it, I'm in. I'll wire you the money. You know, the funny thing is sometimes, I think more often than not, we'll just wire you money before the paperwork's done. So the thing is, like, it's no fixed amounts, no closing. If you want to read something on this, by the way, Paul Graham, the founder of Y Combinator, he wrote a blog post called High Resolution Fundraising. If you just Google it, it'll be the #1 thing. It's definitely worth reading. About what this is like in terms of rolling closes and stuff. There's continuous rounds, not discrete. So discrete means it used to be, just using that analogy, where you get on a table, kick a stapler, and then hopefully a month later have $1 million in your bank account. That's not true anymore. In fact, you know, if you're early, you're probably raising 250K, and then all of a sudden you're doing better. Some other investors come in. Next month you might close another 250. 3 months later, you might do another 250. The point is, it's continuous. And I say this because, like, founders, there's hope for you. And I say this to the investors in the room that, like, don't wait for a lead. You are the lead. Every one of us is a lead on these deals. Prices are beginning to float. So if you agree with me that there's continuous fundraising happening, right? Then the thing is, though, is that let's just say in the best case, let's say you do 250K last month, and then you're doing well. All of a sudden, everybody's interested. You want to do another 250 this month, and then you do really well. 3 months later, you're going to raise another 250. Let's make no mistake that the valuations on all three of those are probably different. Say again? The valuations will change on each round, even if it's only a month in between, as long as there's progress, right? So I say this to the investors in the room because, like, you cannot think that you're going to be the guy or the girl that comes into the round, the last guy into the round, and then get the same terms I did when I took all the risk putting the first money in. And I think investors need to understand that. No boards. No boards. I would argue that if you have not raised $1 million, you should never have a board. If you have a board of advisors, you're an idiot. If you have a board of directors, you're an idiot. Dump that shit. Just dump it. The purpose of the board is governance, okay? The purpose of the board of directors, now let me just be clear, I'm not advocating no boards ever. I'm advocating that boards are now misunderstood. The board of directors' primary responsibility is governance, to make sure that the money is handled properly, to make sure that they hire and fire the right CEO. That's it. Yeah.
That makes a lot of sense to me, but what portion of angels aren't using a term sheet that goes into all the gory details of the board?
Say that again?
What you're saying makes a lot of sense
Yep.
to me. What portion of angels that are practicing now don't use some standard, their own term sheet that goes into all the gory details
I don't think they should be using, so I don't know what percentage, but I would say the good ones are not using custom term sheets. They're using some of the open source stuff, like Series C documents, or there's the FF Founders, I'll send out the links or whatever, but there's open source documents for this, and standards are pretty even. So like, I'll just go out on the record and say, and my attorneys will hate me for saying this, but like, look, if you're a founder and you don't know whether the term sheet the VC or the angel gave you is legit, email me. I'll try to send you the ones that we use. But always have your attorney look at it. But the thing is, though, is that like, just keep it vanilla. Keep it vanilla. Like, we as VCs don't want angels that have too much control in the early stages. And I would argue that founders shouldn't have it. And by the way, to follow up on the board of advisors thing, like, the thing is that there's a lot of really smart people that sit on boards of advisors or whatever, but like, it's almost never the case that they actually provide the ROI that the founder originally thought, right? So board of advisors are not really that useful because it's usually somebody that's sitting, that made a lot of money in the past. And so here's the thing I question about board of advisors. Let me just be really blunt. So the thing is, like, if by definition the people on your board of advisors are badasses in their industry, then in theory they've made their own money. So why the fuck aren't they just investors? Right? Like, if we agree with everything else I said, or even some portion of it, and that even a $1,000 investment is meaningful, if you want to be an advisor, give me $1,000 bucks. I'll give you some equity. If you don't want equity, cool. Then I'll just call you when I need you, right? But you're not going to get equity and like, put on your LinkedIn profile that you're on the board of advisors for my company. That's ridiculous. It's just the wrong thing. Anyway, and by the way, I will rant about all this stuff all the time. So like, if you want to come drink with me later on, like, I just rant about this all the time. People either love me or hate me when I'm done, and I just like it that way. It's just super polarizing. That was like such a hesitant laugh. You guys didn't even know if I was serious or not. That's awesome. And the last thing here is herd mentality exists. We don't want to admit it, but it exists. Try this, right? If you ever run into an investor, if you want to be like really controversial, which you should be, I argue you should be controversial all the time, walk up to an investor and be like, hey, who do you co-invest with? And they'll be like, well, we co-invest with these other people, when I invest, and these other guys usually come in. And you'll be like, oh, cool, so you follow those guys? Like, when they do something, you just do it? And watch their reaction and be like, no, see, like, I just make my own decisions, but, we, like, work together. But what they're really doing is they don't want to admit that they are always looking at each other to figure out if the other guy is going to invest, but they'll never admit that. Now, you guys as founders can't change that, but what you can do is take advantage of it. So what that means is when you're going to go raise a lot of money, or any money, don't go kick the stapler off the desk and tell the entire world that you're going to raise $500,000. Don't do that. Have a target. Have a target list. Go to 5 or 10 people. You can find these people on AngelList. You can probably meet them at events like this. You go and you target them highly specifically, and you get the first domino to fall. The first domino is always the hardest one to fall. Once that comes in, you make the circle a little bit bigger. You open it up to the next 30 targets, right? And you make it a process. It's a process. Everything is a process. Does that make sense? So I should mention, by the way, as an aside here, I think one of the problems with startups as a whole, and perhaps with like our careers in general, we glorify the results, right? So we glorify the fundraise. Hey, that guy raised $2 million. Yeah, that's awesome, right? Or like, we'll glorify the exit. Like, oh, that lady, she sold her company for like $40 million. That's awesome. Or like, yeah, that guy's a VP at Boeing or something. That's awesome, right? But what we forget, and the shame is, that we forget that the process matters more than the results. For every one of you, you probably know that in your own lives, there's like 5 days in a year that are like really awesome, and then 360 that's like the grind. I mean, look at venture capital, right? Like, here I am standing in front of you, telling you stuff that hopefully is interesting. But like, there's a lot of fucking research that went into this, right? I had to sit on airplanes. I do 250,000 miles a year. Most of my job, believe it or not, most of a VC's job is actually not, if you're a good VC, most of your job is not funding companies, it's just being a psychologist. We're just like therapists at the end of the day, right? Founders only call us when they're on emotionally high or emotionally low. Like, oh yeah, we're doing so well, we need more money, this is awesome. Or like, dude, my wife's gonna leave me, I'm out of money, my co-founder just left and he's like hammered all the time. Like, nobody ever calls a VC to say hello, right? So the thing is, the point is though, is that like we glorify the wrong thing. Let's focus on the process, not the results. I hope you guys remember that. What I'm really saying about VC and how it's changing is that the private markets are becoming liquid and efficient. If you look at the stats that I gave you about AngelList, right? You have more and more transactions now that are happening offline, right? More and more retail investors, angels are coming to the market. You have online trading now. Actually, just last week, NASDAQ, I believe, bought a company called SharesPost and also admitted that they're going to come in and try to make the private markets more liquid, right? So the private markets are becoming more liquid and efficient. That's good for you guys. It's good for everybody. In general, I am a big believer in the free market. So, there's certainly going to be some more fraud in the future. There's going to be a lot of people that lose money. There's going to be a few that make money, but the point is, though, is the markets are becoming liquid and efficient. And for those of you that love economics or nerd out on this stuff, like, I'd love to talk to you about this stuff because this is the next big thing. This is the next big thing. I actually believe that within a few years, you guys, regardless of whether you have $1 billion in the bank or 100,000 bucks or like 30, you guys will be able to do electronic trades and say, you know what, I'm going to do 1,000 bucks into every Y Combinator company, and I'll just do it electronically. Just like you do in your E-Trade account. Some of you will go onto your E-Trade account and say, you know what, I'm going to buy 7 shares of Apple and 3 shares of this, right? The point is, though, this is really good, and this is the most profound thing. When we look back at our lives, I mean, we all look pretty young here. We all look back at our lives. I think this will be one of the most profound things that happens within our lifetimes. So here's what I'm really saying about the entire market. That if your business relied on the privileged access to information, the internet totally fucked you up. Right? Because think about this, right? So now certainly if you're a doctor or a professional engineer or a lawyer, those are regulated industries. You have to have degrees. You have to have certification because lives are on the line, right? But like bankers, right? Bankers, we used to basically say like, well, I never went to Harvard. I went to George Mason, right? But like most bankers were like Ivy League school guys, mostly guys, right? And it was like an insiders club and whatever else. Like every industry is now, the internet is like disrupting. You guys, like for example, you guys have no excuse for a shitty pitch. You know why? Because there are thousands of pitches available online for you to look at. You can look at thousands of slides. Like every one of our companies, almost every one of our companies has their slides online, the slides they use to fundraise, the videos of their pitches. It's all there, and it doesn't matter whether you're in Norfolk or you're in Bangalore or you're in Nairobi. You got it. If you have an internet connection, you can now see what other pitches look like. You can go on AngelList. Like for example, at the bottom here, we'll go back. So if you look at the bottom here, angel.co. So that's AngelList, right? If you don't know what your valuation should be, well, you can go angel.co/valuations and look at anonymous data of what valuations are. That's profound because 10 years ago, I couldn't do that. 2 years ago, none of us could do that, right? But now, because this information's out, for those of you, for example, that are successful here, you're no longer likely to get screwed by some local angel that wants 51% of your company. That's bullshit. Like, the point is, though, it's all public, all this stuff. And like bloggers, a lot of the best minds in venture capital are blogging. They're open about their thoughts. You know exactly what they're doing, right? The point is that anybody that relied on privileged access to information is screwed. Because there's guys like us that are giving all this information away now. So here's your key takeaways. Everybody tells you this, right? They tell you to focus on traction, right? You've all heard that. I hope you've all heard that. And that's true. But I'm going to argue that that's table stakes. Like if you didn't know to focus on traction, you probably shouldn't be in a startup ever. But the more important thing, and the thing that nobody will tell you, is that you need to learn to communicate and inspire. You need to learn to communicate and inspire. If you build the best startup in the world, but nobody knows what the fuck you do, is it really the best? The thing is, though, is that like, I think that one of the most common mistakes that young people make is that they will do little quirky things, which are cool in the early days. So if you think about like high school, I don't know if this is true still, it's been a while for me, but like when I was in high school, you would have like the groups that would dress a certain way, or say, like they would end their sentences as questions, right? There were these quirky things. You guys know what I'm talking about? Those quirky kind of things that were cool when you were in high school? Yes or no question. Does that make sense? Because I want to make a point here. What's that? No comment. No comment. So the thing is, those quirks might have been cool then, but as the stakes in your life get higher, those quirks become barriers to your future. Does that make sense? If I'm going to write you a check for $1 million, or even $50,000, or even $1,000, I kind of want to know that you have your head on straight, that you're not like fucking crazy, and that you're not going to make me look like an idiot when one of my LPs sees you. Does that make sense? If you want to learn more about that, go on Quora. Quora, you're probably familiar with. Go on Quora and look at the public speaking tags. Follow that tag, read it, practice it, right? Get comfortable communicating inspiring. Because if you don't believe me, I guarantee you, regardless of whether you do a startup, you go into the corporate world or anything else, you will have a hard time convincing your coworkers of what you're doing. You have a hard time explaining to your parents and your family what you do. You have a hard time convincing the press. You have a hard time convincing somebody why they should join your team. It influences far more in your life than I think most people realize. I hope that's one of the things you remember in this talk. Also, distribution is more important than the product. The product is table stakes. If you remember what I said earlier, product risk, market risk, distribution risk, right? I have to assume that you can build the product. If you can't build the product, you're kind of in trouble. If the market is 0 people that is using it, we're both screwed. If the market is only 10,000 people, that's great for you. You're going to make a very profitable business for yourself. If the market is in the millions of people, the VCs are going to come after you like hungry, hungry vultures. We're going to want a piece of that, right? But market risk is there. And distribution. How are you going to get this thing out there? How are you going to get growth? How are you going to find these people and get them online? That's the thing. I would argue you should spend 80% of your time thinking about distribution, 20% on everything else, whether that's product and all the other stuff. Does that make sense? Tactics are more important than strategy. Here's the thing. So I have no formal definition of what I look for in a founder, but I can tell you that when a founder comes to me and says, here's my marketing strategy, I die a little bit inside. I'm like, what the fuck is a strategy? Like, most of your lives are tactical. I think what makes a difference, so my heuristics are across hundreds of companies that I've funded and thousands that I've said no to, right? So I have a slightly different perspective than most investors and perhaps most people. I have no formal definition of what I look for, but I think one of the common trends that I see in successful founders is that they are relentlessly resourceful, but more importantly, I think that what they do is they have this innate ability to think very big and think very small. And what I mean by that is that like they know, and I don't know how they know this, but they know like what stuff matters and what doesn't. They know, for example, like there's some stuff they can just delegate out to an outsourced firm or whatever, but they know inherently how to actually figure out what really matters and only think about that. Whether that's the color of a button on a page or which way the market's going to go in 5 years. The dirty secret, though, is that nobody will actually know like whether this stuff works for a few years. Here's the thing, right? Here's the real problem, one of the real problems. I can tell if you're crazy. So if I get to know you for 3 to 6 months, and you probably know this too in your own personal lives, if you get to know somebody over the course of like 3 to 6 months, you can pretty quickly figure out if they're fucking crazy. Right? Some people you can tell right away, you're like, that guy is fucking crazy, I don't want to be in the same room. But some people, their tells come out over 3 to 6 months. The unfortunate truth, though, is I can't tell which one of you is going to be a winner for 5 to 7 years. So all I can really do is just curate the hell out of my network. I can, and so the point is, though, is that, so I'm actually writing a book right now, and I'm trying to, this is one of the chapters I'm stuck on right now, is explaining this idea, but I hope that makes sense to you, is that I think if you're doing, so most of us live within the middle 99% of thinking big and thinking small. We're stuck in our day-to-day tactical lives thinking about stuff, doing stuff, right? Running our Google AdWords campaigns, picking up the kids, you know, going to the office. We're doing all this tactical stuff. I really think that there's no money to be made in that. I think some of the best founders somehow figure out how to turn that off for a minute and think about like the little details of what matters. So let me give you an example, by the way, just to try to drive the point home. At 500 startups, we're kind of like, in terms of operations, we weren't, and we probably aren't very optimized. So I don't know if this will surprise you or scare you. We use Google spreadsheets to keep track of the people we talk to. Is that scary? Right? Like the point is, though, is that, but so here's the thing. Here's the thing. If you agree with what I said earlier, it's about access, you shouldn't care whether I use Salesforce.com or Google Doc. All you care about is, do you know how to get in touch with me, and can I get money into your account quickly? Right? So that's like an example of thinking small. Like, if every other VC is explaining to you how much, like if a VC comes up to you and says, we manage $100 billion, you should just walk away and be like, okay, this guy is like, he's like telling me the wrong thing. I don't need that. What I need is help with data design and distribution. That's what you probably need right now, right? So anyway, focus on customer acquisition. The best way, the number one way to fund your company is to get a paying customer. And that's always been the truth. I actually think, I think that companies should stop calling themselves startups. Well, first of all, I don't think any of you guys should call yourselves companies. I think you should call yourselves startups. But the minute that you get one person that you don't know to pay you, you are a small business, and you should behave as such. And you should take cues from every one of these small businesses that's down the street, because if they don't get enough restaurant customers in, they're not going to stay open. This country was built on the backs of entrepreneurs. Our economy was built on the backs of entrepreneurs, and it will continue to be that way. But sometimes we celebrate the wrong part of startups too much. So focus on customer acquisition. Get on AngelList. Whether you're an investor or a founder, get on there. I think we would argue that if you're not on AngelList, you're either an idiot or you have something to hide. It's just that simple. And I hope every one of you, by the end of the day, if you're serious about participating in the startup world in some way, whether it's getting hired by a funded startup or doing one or investing in one, you better be on there. By the way, AngelList is a huge talent pool now. So AngelList today is used for founders that want to hire really awesome talent and founders that want to go meet investors. So if you want to work at a funded startup, you should get on there. Don't go to Monster or any of these other things. Get on there. Raise 12 to 18 months of funding. Do not. So here's a mistake common first-time founders make. Do not walk up to an angel investor or to a VC and say you only want to raise 100 grand. It tells me that you're not thinking big. If you want to raise, I don't care what your background is, what your economic conditions are or anything, like if you want to raise 50 or 100 grand, first of all, I would argue, why do you even need that kind of money to start? But if you want to raise that, there's probably some angels somewhere that can give you that. But that's not the big problem. The big problem is you're probably not thinking big enough. I think the minimum raise should be about 250K. I think that, give or take a little bit, you should probably raise about 12 to 18 months of runway and probably sell about 20% of your company, 15 to 20% of your company. But don't take my word for it. Just go on AngelList, go to the valuations page, and start to do the homework, right? Because that's not always true for let's say you're doing biotech or anything in medicine, you better raise 10 years worth of money, right? Because the FDA is going to try to run you into the ground. But if you're doing a web startup, you don't really need that. So anyway, raise some money. Learn the basics of venture capital economics. Even if you're not going to raise money from a VC, I think you should start to think like investors. And I told you the 3 things that I care about. But actually, if you want to learn more about this, go to a website called venturehacks.com. Venturehacks.com, and click on the archives. Spend a Saturday afternoon and just skim through it. You'll probably learn everything you need to know within 4 hours. And it'll help you just trying to get your head wrapped around it. But think like an investor. Think like an investor. And when I say actually think like an investor, what I really mean, in other words, is I want you to think about things in terms of progress and probability. Progress and probability. I personally think that the best indicator of future success is previous performance. I think that the media will make you think that if you just sit in one of these events long enough, that you're just going to find some magical idea, and then tomorrow you're going to sell that for $100 million, right? But the reality is, so here's the thing. Let me actually say it a different way. I think that what people misunderstand about startups is that they think that there's a eureka moment, that there is some moment where a light bulb goes on in somebody's head, and then through unicorns and puppies, money starts flowing. But the best founders I know, the best founders, some that I've been able to fund, some that I haven't, their success seems to come as a series of approximations or iterations. They iterate their way towards success. They try a lot of shit. Has anybody heard of the recent Mailbox acquisition by Dropbox for $100 million last week? How old do you think that company is? How much? 3 or 4 weeks. Anybody else? Anybody? I've asked this question a lot. Most people think they've been around an average of 7 to 10 weeks. What if I told you they'd been at this for 3 years? And Mailbox was just yet another try. They had other apps that they tried. But it was 3 years. One of the guys in Northern Virginia, actually, he lives down the street there in Ashburn. One of the quietest guys. You'll never know who this guy is. He's the nicest guy in the world, but does not show anything. Anyway, this guy sold a small search company to another small search company called AOL. Ran their search division for a while. Decides to leave, and he recruits the top 5 guys that he loves in that company. And they get a little office in Sterling, Virginia. This is 4 years ago. This is 2008, I believe. Okay. What they were going to do was they were leaving AOL. They were going to create a product that aggregates the reviews on AngelList and somehow figure out, it'll show you guys which stuff is highly reviewed. I hope that as I ramble that out, that you're well, I would never use that, right? But that's what they decided to do. And so, and Jay will tell you this story in a much better way than I will. So they start to do this thing. They're doing it. 11 months later, it's not working. And their morale is down. Everything's down. They left AOL. Arguably they could have had a lot of more money, just steady paychecks. They were senior guys, right? They had access to the best food and everything, and they're working in this little shitty dump, right? But they decide that there's this little service called Twitter, and man, it sucks. Sometimes you saw a tweet an hour ago and you just want to go find that tweet, and Twitter's search functionality sucks. So they just build a better search engine for it. And they build the first version within, I think, 3 weeks, and all of a sudden, huge exit. Huge exit. The point here, the lesson I hope you take from this is you are highly unlikely to be able to predict how you're going to be successful. You must think of your life as iterations and approximations to get closer to the truth, right? Let me just say that one more time. Whether you're doing startups, whether you're in a regular job, whatever you want to do, right? I want you to understand that your life will not be determined by some eureka moment, some stroke of luck, or anything else. That's a fool's search. Your success is actually a function of approximations, a series of approximations and iterations that will get you closer to the truth. Does that make sense? So in plain English, I would say that is like just do a lot of shit and just like the stuff that sticks, do more of that and dump everything else. Coming soon, like little self-plug. So at 500 Startups, when we give you money, we tell you pretty much like, hey, look, we'll answer the phone if you call, but we're not that smart. The thing is, like, in your lives, you guys are thinking about the tactical, as you should. You're thinking about how do I do AdWords campaigns? How do I do search engine marketing? How do I vet this new sales guy that I want to hire? Right? It's really tactical. So why would you ask a VC for their opinion on this? Because A, most VCs have never had a startup before, right? Most VCs have never had a startup before, and B, even if they did, like my last startup that I sold was 4 years ago. The last time that I actually ran an AdWords campaign was 4 years ago. What could I possibly tell you that is useful? So what we do is we build products like Dashboard at 500 where thousands of our founders and their employees and our mentors interact. And now what we're going to do is start opening this up. Now you guys, for example, won't have access to the 500 network, but and I'm going to just spring this on Zach wherever he is, but like if you're part of Hatch, if you get into Hatch, you'll get into the Hatch network. And now you have access to all the people there. If you get into Techstars, you got that network. The point is, like, we want the people to see us as an API to venture capital and functional expertise. And I would encourage each of you to think of yourselves as that as well. If any of you actually want to make Norfolk a better place, I think you should think about packing your bags and going somewhere for a little while. And I mean that seriously. I think what you should do is you should think about going to Silicon Valley once a year. I think you should think about going to New York City once a year. I think you should get out of town, get some perspective, meet other founders. You'll find that it's always open. But if you want to make your home city better, go somewhere else for a little bit. It's funny, most startup communities, they try to like model themselves on Silicon Valley, right? That's what they do. They say like, how can we be more like the Valley? And that's just a fool's errand. Why would you do that? Like, thousands of cities have tried to be Silicon Valley and they've all failed. It's not important that you're in the Valley, actually. It's just important that the Valley is in you. And what that really means is Silicon Valley is an inspirational place. And it's a place that will instill a sense of urgency in you, the likes of which you've probably never seen in your lives. It will scare the shit out of you. Because like the thing about places like the Valley is that nobody cares where you went to school. They don't care whether you came from a rich family or a poor family. They don't give a shit. What they care about is what did you do yesterday, what did you do the day before, and what are you going to do today? And the bullshit filters are up here. You have exactly one chance every time you meet somebody to just show them that you're going places and you're going to do stuff. So the point is, take a little bit of that. I really think all of you should think about spending at least a week in the Valley. Just go, and you'll find like our office is always open. You'll find it's so surprisingly open. It's so surprisingly open in the Valley. You'll be able to just plug in so fast. That's all I got. So all these slides are online. I'm pretty easy to reach on Twitter, on email. My blog's up there. You can download these slides. My hope for you is that there's something in here that helps you, regardless of whether you're running a startup, you want to run a startup, or you want to do something, in the corporate world. I hope there was something useful for you, and I appreciate the time. Thank you. Cool. Thanks for having me, man. Fun.
Any questions? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37, 38, 39, 40, 41, 42, 43, 44, 45, 46, 47, 48, 49, 50, 51, 52, 53, 54, 55, 56, 57, 58, 59, 60, 61, 62, 63, 64, 65, 66, 67, 68, 69, 70, 71, 72, 73, 74, 75, 76, 77, 78, 79, 80, 81, 82, 83, 84, 85, 86, 87, 88, 89, 90, 91, 92, 93, 94, 95, 96, 97, 98, 99, 100, 101, 102, 103, 104, 105, 106, 107, 108, 109, 110, 111, 112, 113, 114, 115, 116, questions.
Did everybody believe everything I said? Fuck, that's awesome.
Thank you guys. Thank you.
Thank you guys. Thanks, Zach.